Welcome to the deep dive. Today we're looking at Alphabet, GOG,
Yeah.
and asking, is it maybe a surprisingly good investment right now? We're using an article from The Smart Investor,
Right.
and the plan is to, well, pull out the key stuff about where Alphabet is now and maybe where it's headed.
Okay. Well, their latest numbers are certainly interesting. Q1 revenue up 12%.
Which brings it to $90 billion, right?
Exactly.
Yeah.
And the profit was even more, well, impressive, up 48%.
48, that's huge. Came in at $28.10 per share.
Yeah, much higher than the $21 forecast. So a big beat there.
Definitely. And it wasn't just search doing the heavy lifting, was it?
No, not at all. The cloud part, Google Cloud, that grew 28%.
Wow.
Yeah, hit $12 billion in revenue for the quarter.
Okay. And then they also announced the buyback.
A big one, $70 billion stock buyback program.
Right.
And they bumped the dividend too.
Right, a 5% increase. So, I mean, on the face of it, everything looks really positive.
It does. It really does.
Yeah.
But the article we looked at, it flags the elephant in the room.
The antitrust stuff.
Exactly. The potential for regulators to step in, maybe even force a breakup.
Which sounds bad initially.
It sounds bad, yeah. But the argument in the piece is maybe it's not. Maybe it actually unlocks value.
Okay, interesting angle. So how would a breakup actually increase value? What's the thinking there?
Well, the idea is the sum of the parts could be worth way more than the whole thing is now. They put some estimates on it.
Like what?
Okay, so Google search on its own, maybe $2.23 trillion. They compare it to, like, Microsoft.
Microsoft. Why them specifically?
Well, I think the logic is similar market dominance.
Yeah.
Search for Google OS and enterprise software for Microsoft. That kind of scale and influence.
Gotcha. Okay, what about the other bits? Cloud.
Google Cloud, they benchmark it against someone like Snowflake. The estimate there is around $668 billion.
And YouTube. Everyone uses YouTube.
Right. Compared to Netflix, maybe $442 billion.
Right.
And then you've got the ad network, other bits and pieces. They bundle that and compare it to something like the Trade Desk, putting it around $789 billion.
True. If you add all those, let me see, 2.23 plus 0.67 plus 0.44 plus 0.79, that's over 4 trillion.
Yeah, roughly $4.1 trillion, which is, a lot higher than Alphabet's current market cap.
Oh, way higher.
Exactly. And get this, that $4.1 trillion doesn't even really include Waymo.
Oh, right, the self-driving car unit.
Yeah, the robotaxi business. That's valued separately at maybe $45 billion right now, but its long-term potential isn't baked into that huge number.
So the breakup scenario potentially unlocks a massive amount of value, but what if that doesn't happen?
Well, that's the other angle the article takes. Even without a breakup, Alphabet might just be undervalued as it is.
How so? Based on what metrics?
They point to its price-to-sales ratio. It's about 5.7 times sales right now.
And that's low.
It's about 17% below its one-year average. So yeah, compared to its recent history, it looks a bit cheaper on that basis.
Okay, and what does a lower PS usually suggest?
Well, it could mean the market isn't giving as much credit for each dollar of revenue as it used to. Could be an opportunity if the business itself is still strong. Plus, their price-to-earnings ratio, the PER, is around 20.
Which, considered?
Pretty reasonable, actually. More affordable, maybe, than some other big tech names.
Right, and there's still growth projected, even without any breakup drama.
Oh, yeah. Forecasts suggest maybe 63% growth potential by 2027. And again, that's just based on current trends, not factoring in any value unlocked by splitting up.
So the argument boils down to, you've got growth from things like cloud, you've got potential value based on current ratios, and then you have this kind of wild card possibility of a breakup creating even more value.
That's basically it. A blend of growth, value, and maybe some stability with this potential catalyst on top. It suggests investors might see gains in a few different scenarios.
Interesting. So whether regulators act or not, the analysis seems to suggest Alphabet's looking like a potentially compelling case for investors.
Which does lead to a final thought, something for you listening to maybe chew on.
Go on.
What does it really mean long-term to invest in a company that has these huge growth engines firing, but also faces the serious possibility of being fundamentally restructured? What does that duality tell us about where these tech giants are heading?
Yeah. That tension between massive success and potential forced change, definitely something to think about.